Hi everyone, welcome to today's video. So if you have been born and raised in India, you would have always noticed that our parents stress a lot on buying gold. What is the reason? I can explain that to you by showing you one single chart. And here is the pricing chart of gold. So look at the fact that in 1970, the price of the gold was 184 rupees. Then by 1980, it went all the way to 1330 rupees. Then by 1990, it went to 3200 rupees. And if you continue to do that exercise, you will find out that in 2022, the price of 10 grams of gold stands at roughly 50,000 rupees. So gold in INR terms has given massive returns. Okay, now let me show you another picture. So here is the same gold chart and this data is from the US. So here you would notice that the price of gold was roughly $289 in 1970. By 1980, it went to 2394. So there was a significant jump. By 1990, it came down. By 2000, it came down further and got reduced by half. Then it went up and it has been trading sideways. So what is the reason that the gold is giving a lot of returns in India, but not giving the same type of returns in the US? I will reveal the answer along the video, but I told you this story to help you better understand that just by looking at the price movement, you will not be able to understand the real value generated by an asset. So on this video, I am going to help you understand 7 different asset types that you could consider building your positions in, or in case you are investing in any of these different asset types, what are some of the key points that you should remember in case you are taking positions in 2023. So let us kickstart our conversation and let us first and foremost talk about stocks, which is one of the most favorite asset types, and what are broad things that you need to keep in mind while investing in stocks in 2023. So the first and foremost point that you need to understand about stock investing is that you can't time the market. Neither me nor anyone else can tell you that what markets are going to go up or down in 2023. Yes, all of us can have our estimates. I have made a lot of videos on estimating what is going to happen in 2023, but those estimates can go wrong. So the first key important point is that no one can predict what is going to happen in the stock market, whether the markets generally will go up or down. But having said this, it is very important for you to have a hypothesis. Hypothesis means that you need to estimate what is going to happen in the stock market and accordingly build your position. So from that perspective, you need to understand 3 critical points. So the first key point is that in the stock market, there is something called as growth stocks. So growth stocks are stocks like tech stocks, finance stocks, sectors which have high beta. Beta simply means that if the Nifty gives a return of 10%, then a high beta stock is going to give a return of 15% or plus 20%. On the flip side, if Nifty falls by 10%, then it is very likely that a high beta stock is going to fall by minus 15% or minus 20%. So if you are investing in the stock market in 2023, you must first and foremost make a call whether or not you should be investing in growth stocks, or point number 2, you should be building positions in defensive stocks. So what exactly are defensive stocks? These would be low beta stocks. For example, these would be companies like Hindustan Unilever, Nestle, etc. etc. So these companies have products which are everyday use products. Their consumption is not going to go down massively in case there is a slowdown in the economy, etc. etc. So you need to have a hypothesis that in 2023, should you be investing in growth stocks or should you be investing in defensive stocks? Your third option in the stock market becomes that you can take a more balanced approach and you can go and do index investing. Index investing has its own challenges. Again, please check my video here. I have explained that an index bubble is forming. A lot of smart investors are advising against index investing, so you need to make a call. But to cut the long story short, you have 3 options in the stock market in 2023. Number 1, you can go and pick growth stocks. Number 2, you can go and pick defensive stocks. Number 3, you can go and do index investing. Number 4, you can just wait and watch. This 4th strategy has been statistically proven to be really bad. No one can get this 4th point right. So very quickly explaining my viewpoint that I am betting on growth stocks in 2023 simply because of the fact that the macroeconomic factors tell us growth will come back sometime in the next half of 2020. Again, I have done a complete analysis of Nifty. You can go and check that video. My estimate is that Nifty will hit 21,500 sometime next year. The recovery or fast recovery should start after the first quarter of 2023. So let me show you 2 quick data points as to why am I saying that. Number 1 data point is regarding inflation, and as you might have seen that in the US, the inflation peaked at around 9%. The Feds kept on increasing the interest rate, and now the inflation has started to come down. So what can we definitely say for sure? That the inflation has already peaked in the US. Something very similar has started to happen in India also, that we hit peak inflation couple of months back, and now as per RBI, the inflation has started to come down again. So as a result, my estimate is that the increase in interest rate, which is kind of dumping down the market right now, that will be stopped or it will mellow down. And at one point in 2023, the interest rate will be cut. So as soon as the interest rate gets cut, there will be aggressive growth in the stock market. So therefore I am bullish and investing a lot of money in growth stocks. Which specific growth stocks, I will probably make a separate video on that, but I hope you got my perspective of investing in the stock market in 2023. Just a very quick side note that I keep on making different macroeconomic analysis videos, and I help you understand what different investors are saying and what are their concerns about the market also. If you are in the habit of just watching my thumbnail and going away, you are doing yourself a disservice. Please either watch the entire video, understand the whole commentary, and then take positions. Otherwise, if you just watch half the stuff, it will be bad for you. I'm not into the habit of making 1 minute funny content. My content is serious, and in case you do like this type of content, do press the like button. It would allow more people to get useful financial information. So moving on, I also feel that the market is ripe for a growth. Again, this is my estimate. Why am I saying this? So take a look at this chart, and what you would see is after every major crisis, unemployment peaks. You can see this in 2000 dot-com bubble, in 2008 financial crisis, in 2020 crisis, and in 2022 crisis, the unemployment is likely to peak sometime in the first quarter of 2023. What immediately happens after unemployment peaks is that a phase of recovery happens, and that is the inception point of a bull run. So all the macroeconomic studies point to the fact that the peak unemployment after this current crisis is likely to peak in some time in 2023 first quarter. Therefore, I am quite bullish about equity investing in the year 2023. So now comes the second asset type, which is called as the insurance. Now the interesting part is that the rate of medical inflation in India has been 14%, 14%. Just for comparison, the inflation in India right now is somewhere around 7.5%, and the medical inflation is almost 2 times that of general inflation. So these are very high inflation numbers. So you might say that, okay, you know what, why should I buy insurance in the year 2023? I will wait for 2025, 2030, then I will see if I need insurance. Actually, the problem is that your insurance premiums, the older you become, the more premiums you will have to pay. And whatever rates you get, especially when it comes to term insurance, it gets logged in. For example, if you're buying insurance at the age of 25 versus if you're buying insurance at the age of 35, there could be a difference of 70% in your insurance premium, which is a fairly high premium to pay. So therefore, if you are considering buying insurance, A, do it very quickly. Second, do check Ditto, which is an excellent insurance buying platform. They offer spam-free services. You can speak with an insurance expert and there is no obligation to buy from them. You can check the links in the description box. They are the sponsors of today's video, and even me and my family has bought insurance from Ditto, and you can check it out. Now the third asset class where you could consider investing your money in is cash or hard cash. Okay, so what is meant by hard cash? For example, it simply means that you are getting a salary of 1 lakh rupee, and after all the kharcha farcha, investment, this, that, you are able to save, let's say 10,000 rupees. That is kept in your savings account. So what you could consider doing is fixed deposit. So that is how I am defining cash. So in 2023, holding some cash, is it a sensible move? Yes, it is actually a very sensible move. Now, why am I saying this? It is because of 2 reasons. Reason number 1 comes from this particular chart, and what you would notice is that the interest rate offered right now is quite high. For example, if you go to HDFC Bank, then the interest rate on your fixed deposit is now at this juncture is around 6.5%, depending on how much FD you are doing. If you go to some lower tier banks, for example, IDFC First Bank, then you can even get up to 7.5% on your fixed deposit. So this is a healthy rate of interest that FD deposits right now are offering. Now, while I can't predict what the interest rate going forward in 2023 would be, but if you do a fixed deposit now and hold it till 2023, I don't think that that is a bad idea. Simply because of the fact that these type of FD rates existed somewhere in 2018, 2019. So these are decent FD rates that you are getting. Also, it is quite likely that this interest rate is going to come down with time. maybe it will start coming down from next year end onwards. Second key reason for holding your cash is that there can be massive buying opportunities in the market in 2023 as well. Think about it this way, that as investors, it is our responsibility to hedge for any type of market. While I am bullish that the markets are likely to give an uprun in 2023, there can be a scenario where the markets just go sideways, or there might be some kind of massive buying opportunity that might come in. And given the fact that FD rates are decent enough right now, it is not a bad idea to hold at least 10 to 15% of your money in cash. So the next asset class is real estate. Now the question comes that in 2023, should you be buying or selling real estate? Well, this can be ascertained by figuring out that in 2023, will it be a buyer's market or will it be a seller's market? How to do that? Let me illustrate by giving you an example. So let me use my own example that recently I decided to purchase a villa in Goa and I got a good rate. And let me explain it to you. Why was that the case? Because the villa that I got in that same locality, other people are also selling their villas, but they are doing it at 25% markup or 25% price increase. But why was I able to get a good deal? Let me explain that. So imagine that I as a buyer am looking to buy this house. Now, what would be a buyer's market? A buyer's market would be a market where there are very few buyers available in the market. Now, what would this factor depend on? It depends on a lot of things, but one of the key things that it depends on, for example, right now, if you go and check with HDFC Bank or a bunch of other different banks and ask them that I am looking to avail a 1 crore home loan, you will get a rate of interest at approximately 8.5-9%. So which is a fairly high rate, because if you go a year back, this rate of interest would have been significantly lower. Now in India, majority of the buyers buy real estate on an EMI, and if the interest rate is risen by 1% on a 1 crore loan, that can create a 10,000 rupee difference in terms of your monthly EMI. So therefore, I feel that if there is a lot of risk in the economy, that is probably the best time to buy real estate. I purchased some in the year 2020, and now sitting in 2022, when the interest rates have become very high, there will be fewer buyers in the market because majority of the people would not be able to service this EMI. I will be getting good deals. So I feel that till the year 2023, the real estate market will be a good buyer's market. I do not mean that you buy the real estate in 2023 and sell it off in 2023. That's not going to work out. What is going to work out is that you buy real estate when you're getting a good deal and then you exit. Let's say hypothetically in 2025, 2026, when the government is bringing more liquidity, when the interest rates go down, then you will have a lot more buyers. So then you can sell it off at a better rate. So according to me, real estate is a very good asset to invest in the year 2023. So the next asset that we are going to quickly touch upon is the gold and silver, and I will also reveal the answer as to why investing in gold in the year 2023, 2025, 2030 is not a very good deal. So let me again take you back to that chart that I was showing for India, and you saw the prices of gold in India skyrocketing decade on decade. But the second chart that I showed you for the US, there the gold price was rarely moving. Now why was that the case? There are two reasons for that. So number one, the US data that I showed you, it was based on inflation adjustment. So that was the real return of gold in the US. So in economy, what happens is that inflation goes up for everything. So the first graph that I had showed you for India, we had not accounted for inflation. Therefore, that growth from 180 rupees to 500 rupees looked a lot, but it was not if you would have taken inflation into account. And the second and more prominent factor is that in addition to this economic inflation that happens all across the globe, there is inflation of our currency also vis-a-vis US dollar. So the INR keeps losing its value at least by 4 to 5% every single year compared to US dollar. So if you adjust both economic inflation and the INR inflation, then gold has hardly given any real returns even in India. On top of that, the majority of retail buying and selling of gold that happens in India, it happens in jewelry format. So you easily lose 2 to 3% commission both ways. So in total, you are losing 6-7% commissions when you're going and trading in gold. So the next asset class that I want to quickly touch upon is the debt asset class, or more specifically corporate debt. So you might have seen a lot of companies paying 9%, 10%, 12% on corporate debt. So is it safe to invest in these type of companies right now or in the year 2023? Well, it's a tricky answer. So I will help you understand both sides of the equation, and then depending on your understanding, you can take positions. So this is what Ray Dalio has to say on bond investing, that it looks a little bit risky right now. Let me help you very quickly understand his perspective. So this is how corporate debt works. So there are companies like Hindustan Unilever, ITC, they require money, they go go to equity market or stock market to raise some money, and they also go to corporate debt or bond market where they promise a certain yield to the investors. So let's say that you are an investor, ITC comes to you and say that, you know what, that we are going to pay 9 or 10% return. So you need to ask yourself a simple question that, okay, if you are giving money to these companies, will they be able to generate or compound whatever money they are taking and grow it by at least 12%? Otherwise, it doesn't make sense that a company is borrowing, let's say 1000 rupees from you, and they're losing money on it. So when will they lose money? They will lose money when they are not able to find projects or investment opportunities that is generating 12% return for them. So this is a simple analysis that you need to do before taking positions in debt. This is a slightly complicated topic. In case you want me to make the video on this topic, first and foremost, please like this video and share it with your friends. And second, do comment, then I will make a separate video on that. But just to give you a very quick understanding, the interest rates have gone up quite dramatically over the last few months. As a result, the companies have to offer a higher interest rate, but going forward, maybe in 2023, they might not be able to generate 12-13% return on the debt that they have taken, and many of these companies might default. Therefore, debt investing is riskier. In case you want to invest in debt, please invest in blue chip debt. Blue chip debt means that FD, fixed deposit type of debt, that is okay, because if the bank goes under, then the government can bail them out. Okay, so the seventh asset class is crypto. Now, the moment I say the word crypto, I will end up getting a lot of hate, especially given the market sentiments right now. So let me help you quickly understand about the crypto dynamics through one simple story. So this is a picture that has been posted on Twitter by an Argentinian, and you can see that a person paid a restaurant bill by using all this stack of money. The inflation in Argentina right now is 83%. Now you might say that, okay, Akshat, you are handpicking a story from Argentina. What about other economies? Okay, so Lebanon, same issue. Turkey, same issue. Sri Lanka, same issue. Pakistan, same issue. Even UK seems to be going that way. And a bunch of European countries might go this way. Tell me, if such a situation happens in any part of the world, what is it that an investor could do? So you might say that, you know what, go and invest in gold, you are going to make crazy money. Okay, so in case you have to cross the borders from Lebanon to some other country, or if people flee from Turkey to some other country, do you think that they can carry gold bricks and move from one border to the other? The answer is no, the gold will get confiscated. Do you think that the real estate market will survive? Yes, the real estate market will survive, but unfortunately, real estate will become illiquid. You can run a business on real estate, but you can't go and sell your real estate in a doomsday-like scenario. So even that goes out. What about stock market and bond market? Well, they will completely crash, as has happened multiple times in the past. You will say that, okay, cryptos are unregulated. Why are you talking about cryptos, this, that? Please, if you have been a regular watcher of my channel, you know that I am a diversified investor. I have said it on almost every single video of mine that the positions that I take on crypto is 10 to 15% of my portfolio, not more than that. And literally there are two cryptocurrencies where I invest almost 95% of my crypto money, which is Bitcoin and Ethereum. These are layer 1 protocols, and my investment thesis of investing in crypto is to protect myself in a doomsday scenario. Of course, there will be a bunch of counter questions that, you know what, Bitcoin has been demolished by 75% this year. Well, this is the fourth time that is happening with Bitcoin. So it's not as if that Bitcoin has been dead. On top of that, there are companies like Meta, which have been crushed by 80%. So would you call them a scam too? On top of that, many people say that, hey, cryptos are not regulated, or there are exchanges like FTX, which was unregulated. Well, FTX UX was regulated by UX. Now I understand that the sentiments are against cryptocurrencies. I am not trying to get you into that space. It is your personal call whether you want to invest, not invest, watch from the sidelines, etc. I honestly share whatever I'm doing in the market. Since many of you have asked me to present my viewpoint on cryptos, I have done the same. I hope you enjoyed this video. Do press the like button, and I will see you soon.